The biggest issue, I think, in front of American investors isn't global politics, but rather American politics. At the federal level, I don't think it's any history or any mystery to people who studied it. The U.S. federal government owes the bondholders about $37 trillion. Now, to put that in perspective, that's 120% of GDP. But to put it in a different perspective, gross federal revenues annually are $5 trillion before we spend any money. We owe 37 and we make 5. This is a truly ugly number. The only way out of this dilemma for us is to reduce the purchasing power of the US dollar, which is to say, honor the nominal value of our obligations by inflating away the real value of our obligations. We did it in the decade of the 70s, where the Office of Management and Budget would suggest that the US dollar lost 75% of its purchasing power over 10 years. I think that's what's coming to us.
Welcome to Discourse with Christian. I'm your host, Christian White, and today's guest is Rick Rule. Rick is an investor, speculator, and founder and CEO of Rule Investment Media. Rick, thanks so much for being on the show today.
Pleasure, sir. Thank you for giving me a chance.
Well, I've been striving to get you on the show for some time, and I want to give a shout out to Pigo's trading desk, Tony Encino and his brother Derek, and then of course Callie for helping to make this happen. I figured we'd start off first with about your symposium that you have going on next month, and then we dive into the global economy, financial markets, so on and so forth.
Great. I look forward to it.
Go ahead. Sorry.
Talking about the symposium, I'm informed, perhaps reliably, that it's in its 30th year, which is great. We've tried to make it a little bit better each year, which after 30 years means it's pretty good. It's important to note that over 30 years, it's been all natural resources. We haven't tried to do tech. We haven't tried to do, marijuana or narcotics. We haven't tried to do crypto. We've done one thing, natural resource investing. It is a great conference for a whole bunch of reasons. One, because after 30 years, we have a core of attendees who are themselves very knowledgeable. The idea that all the knowledge in the room emanates from the dais out to the masses is silly. There's a whole bunch of hardworking, smart, high net worth people in the audience. So if you come, pay attention to the conference attendees around you who have a lot of knowledge. We do a different kind of big picture macro, Christian. We don't have influencers or journalists doing big picture macro. We have people who have been players in the organizations that they describe. David Stockman will comment on the U.S. budget, the U.S. deficit, and the impact of that on your portfolio. He's not a failed journalist. He ran the Office of Management and Budget under Ronald Reagan and wrote a book detailing the derailment of the Reagan Revolution by Republicans and Democrats within 6 months of Reagan's inauguration. He called what would happen with Doge and this latest shameful budget absolutely accurately. What's important to note is that he's a player. He's not a commentator. We move on to Daniela DiMartino Booth, who'll talk about the Fed as a former Fed researcher. Nomi Prinz talking about Wall Street as a former partner at Goldman Sachs. Jim Rickards talking about the intersection of Wall Street and government. He was general counsel for long-term capital management when their failure almost took down Wall Street. After we're done doing big picture macro, but not in the way that ABC or CNBC might do it, we take you to portfolio managers around natural resources, people who have 30 or 40 years experience through good markets and bad, who can tell you about the mistakes they made and how you can avoid making those same mistakes. We have the living legends, entrepreneurs live on stage who've built multi-billion-dollar companies from scratch, telling you how they did it, telling you how you can identify the 20 million market cap, which is going to become a $2 or $3 billion market cap. Unlike every other investment conference on the planet that I know of, every single exhibitor at the conference has to be owned in accounts owned by the sponsors of the conference. Sadly, Christian, that doesn't mean that because I own a stock goes up, but it does mean that I vetted every single exhibitor because I own them. Finally, all of those attributes allows me to make your listeners a really, truly spectacular pledge. If you attend that conference, the Natural Resource Investment Conference, July 7 through 11, either in Boca Raton, Florida, or via live stream in the comfort and convenience of your own home. If you think for any reason that I haven't delivered the value that I promised you, simply email me and I'll give you your money back. This is financially a completely riskless proposition. I'm delighted to say, after 30 years of money back guarantees, we've had to refund less than 1/10 of 1% of the tuitions that we've charged. But that guarantee is your guarantee that we're confident that the value that we deliver will benefit you.
Hard to beat that. And it's amazing. And I'm not going to pretend to be some expert in the natural resource space by any means, but it's striking how little of your average Joe walking down the street has no awareness of this and sound money and other things that are obviously critical at this time junction.
So true. So true. It's amusing to me that most people don't even know about gold, despite the fact that it's a four-letter word. Most people can't spell it. It's really, really, really an underowned. All of natural resources are underowned asset classes.
Absolutely. Well, I figured we would get started with the show here, perhaps starting off with your macro take as it relates to the global economy, financial markets, and maybe a little bit of your thoughts on current geopolitical scene out there, if you care to entertain us.
Question, but I'll do my best. The biggest issue, I think, in front of American investors isn't global politics, but rather American politics. Um, at the federal level, I don't think it's any history or any mystery to people who studied it, but the U.S. federal government owes the bondholders about $37 trillion. Now, to put that in perspective, that's 120% of GDP. But to put it in a different perspective, gross federal revenues annually are $5 trillion before we spend any money. We owe 37 and we make 5. This is a truly ugly number. Amusingly, it gets worse in two fashions. That deficit, the debt, grows by $2 trillion a year, which is to say the debt itself grows by 40% of the gross federal budget annually. I laugh. It gets worse. The net present value of unfunded liabilities, not what we owe the bondholders, but what we allegedly owe each other or have promised each other. Medicare, Medicaid, Social Security, federal government pensions, military pensions. That number, the net present value of unfunded entitlement obligations at the federal level, not state and local, at the federal level, exceeds $100 trillion. Now, to put this in perspective, the Internal Revenue Service estimates that the aggregate private net worth of American citizens is $141 trillion. Of that 141 trillion, we owe 136 trillion. And that number grows by 2 trillion a year in on-balance sheet obligations and another $2 trillion a year in off-balance sheet obligations. This is profoundly bad math. Profoundly bad math. And I would suggest to you, Christian, that the only way out of this dilemma for us is to reduce the purchasing power of the US dollar, which is to say, honor the nominal value of our obligations by inflating away the real value of our obligations. We did it in the decade of the 70s, where the Office of Management and Budget would suggest that the US dollar lost 75% of its purchasing power over 10 years. If you reduce the purchasing power of your nominal obligation for entitlements from the $100 trillion real number to a $25 trillion nominal number, that number becomes somewhat more affordable. Unpleasant for the people who count on entitlements as being part of their retirement or lifestyle plan. But I think that's what's coming to us.
Now I know it's been said, of course, that it's mathematically impossible for them to rectify the situation. I mean, whether it's various shows and pundits, so on and so forth. Wanted to ask you real quick some speculation about Trump's Bitcoin reserve or stablecoin or some other type of instrument or means to try and negate or satisfy the debt. I'm agnostic as far as Bitcoin goes and all, but what's your thoughts on that when you hear some people speak of that?
I'm agnostic too, but I'm critical of a plan to invest money you don't have in an asset class you don't understand. There is a real sure way to generate a return on capital employed, and that's to reduce your debt so that your interest expense goes away. Uh, unlike many of Mr. Trump's critics, I read his book, The Art of the Deal. And The Art of the Deal is fairly straightforward. It's transactional. My suspicion is that Trump's fondness for crypto and Bitcoin has to do with the wishes of big donors. H.L. Mencken once said that elections are best understood as advanced auctions of stolen property. And in this case, the crypto class were high bid. The idea that you would establish a sovereign wealth fund when the sovereign has no wealth and invest that in a new asset class that you don't understand, when you have a guaranteed return by paying down the debt, strikes me as being particularly silly politics. Perhaps the politics of hope, likely the politics of contribution.
Yeah, it's very interesting to see much of the demand into Bitcoin. I mean, obviously, some see it as kind of it's the next thing since sliced bread, if you will. I've heard the pros and cons to it, but as far as financial markets, global economy goes, and at the macro level, do you have any commentary you care to share as it relates to whether it's BRICS or other things outside the U.S. that you're kind of keeping tabs on?
I'm a global investor because I invest in natural resources and financial services, and because natural resources in particular occur. I've had the good fortune to invest in a lot of countries for a long time, and so I, in fact, watch them. And there's both good news and bad news there. The good news is that in the last 40 years, on a global basis, we've done a spectacular job of making the poorest of the poor less rich, or less poor, pardon me. We've raised over 2 billion people worldwide from dire poverty, where their biggest risk was starvation, to being merely poor. And we're continuing to do that. I would suggest that our greatest achievement as a species in the last few years was in China, where Deng Xiaoping, saying to be rich is glorious, ushered in saving 550 million people from rural penury into at least a lower middle class existence. And we're going to finish the job. There's a billion people on Earth that have no access to primary electricity. And I suspect that 25 years from now, almost no one on Earth uh, will not have access to electricity. That has important ramifications in the natural resource business. When people around the world get more money, when the desperately poor get more money, what's important to them is all stuff that involves commodity. Christian, when you get more money, you buy a service or you buy some little gizmo from Apple that weighs about 2 grams. But when a poor person gets more money, they raise the calorie count of their family. They replace a mud hut with cinder block. They replace a thatch roof with a steel roof. They upgrade from barefoot to sneakers to a bicycle to a 50cc motorcycle to a Toyota Hilux. The thing that raises the material living standards of desperately poor people are all commodity intensive. And we're facing a 20-year period where that growth in demand is absolutely inexorable. And we're facing it having spent 30 years as a species under investing in the productive capacity around natural resources. When demand increases and supply falters, it does a really interesting thing to price. There are other things that we should talk about. There's a discussion in the market that the US dollar will cease to be the world's reserve currency. Maybe, but not in my lifetime. And I'm a very, very healthy 72-year-old. The US dollar, for all its faults, is very liquid, and we have a completely transparent securities market in the United States, unlike other countries. My friend Doug Casey once said the US dollar is an I owe you nothing. Well, the euro is a who owes you nothing. And the BRICS, well, that's a nobody owes you anything. How can a basket of unconvertible, illiquid, opaque securities ever constitute a currency? In a past life, I used to sell financial products to very, very, very large sovereign wealth funds and parastatal organizations. And I remember in the early part of the 2010 to 2020 decade, talking to Asian sovereign wealth fund managers and asking them about U.S. securities. I pointed out that our large deficit, our debts, made me uncomfortable with U.S. treasuries. And I said to them, we have a really good deal with you. You send us cars and computers and steel and stuff, and we send you back pieces of paper with dreams painted on them. Sounds like a good idea to you, to me, but what about to you? And they sort of laughed. And I said, I mean, the treasury to me seems almost like a lie. And I will never forget my Asian counterparty saying to me, ah, yes, Mr. Rule, what you say is true, but yours is a deep and liquid lie, unlike all the rest of the lies that we're told. I said further, do you trust us? He says, oh, no, but we trust you more than we trust each other. So I would suggest to you that the demise of the US dollar is a greatly overstated risk. I think that the absolute value of the US dollar declines, but I don't think that the relative value of the US dollar compared to other currencies necessarily declines very much.
Yeah,
Uh,
I've heard
why?
it. Oh, sorry.
I'm sorry.
Oh no, I'm sorry. I cut you off. Go ahead.
Uh, when I paint this semi-bearish case, there's a bullish case too, which is to say that the advance of technology continues unabated. The United States, for all its sins, is still a culture where a group of kids can take over a garage in Sunnyvale, California. Out pops Google or out pops Apple. The history of the United States is that our individual hard work, brilliance, tenacity has funded our collective stupidity. It's been a very difficult job, but we've actually earned faster than the government has wasted our money. And the bullish thing internationally is that because of the distribution of education, because of the internet, because of communications, that garage, the next garage doesn't have to be in Sunnyvale. It could be in Lagos. It could be in Jakarta. The idea that we're unleashing the potential of humankind, irrespective of where it is and irrespective of background, is enormously bullish. Hugely, 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 hugely bullish. Not so much fun, maybe, if you're an entitled American expecting a nice living standard out of your birthright and unwilling to compete with an Indonesian or a Nigerian. But for humankind, the idea that we can harness the collective intelligence and drive of all of humanity, 8.2 billion people, rather than 400 million people, that's something that makes you bullish. The bearish part, easy. Uh, Economic nationalism, xenophobia, prejudice, war will challenge us. We have gone from, at least on the surface, embracing free trade, embracing the inclusion of many nations in the global economic fabric, to being fragmented again, to becoming economic nationalists, to becoming the slaves to political elites. Uh, and that's not so good. So there's going to be lots and lots and lots of competing forces. And one will need to play the game, I think, rather carefully in the next 10 years. The period, Christian, that we've been through, the period specifically 1982 to 2022, 40 years, were the most benign economic climate, I would suggest, in the history of humankind. Real and nominal interest rates fell. There was US dollar hegemony for better or worse. We were less profligate than other people. We enjoyed the demographic boom of the baby boomers, coming of age, working, saving, investing. There was receding economic nationalism for those 40 years. There was an inclusion of all kinds of people, including hundreds of millions of women, into the workforce. And a lot of that demographic tailwind is past us. Real interest rates aren't falling anymore. They're rising. xenophobia, racism, economic nationalism are increasing. The baby boomers have busted, which is to say, the demographic boom that everybody enjoyed as a consequence of my generation is over. And the baby boomers left a bad legacy. We voted ourselves all kinds of cool benefits, and we forgot to pay for them. We're leaving you the bill, uh, which is where that $100 trillion came from. So there's good and bad. What's important is that you note that things are changing. And the game plan that worked for people over the last 40 years is very different than the game plan that's going to work for people over the next 10 years.
This sounds very much similar to like Fourth Turning and many others. If you care to provide any other commentary, perhaps your thoughts on whether the West will be able to recover or if it's just a spiral decline coupled with the debt. I don't know if you have any.
Absolutely. My friend Robert Friedland uh, told my audience a couple of years ago, he said, Rick, the situation's hopeless, but it need not be serious. uh, just because all of those about you are losing your head is no reason for you to lose your head too. Certain asset classes will do well. I think gold is an example. If you look back at the decade of the 70s, when the US dollar lost, by the government's own estimate, 75% of its purchasing power, the gold price went up 30-fold. I'm not suggesting that the gold price will go up 30-fold from here, but I am suggesting that the nominal price of gold will increase commensurate to the deterioration of the purchasing power of the US dollar. That's important to note. Um, I think, though, that adopting a strategy that's predicated, as an example, on buying all dips because the interest rate is falling, uh, not a good strategy. There will be problems with greater disparities in earnings power and wealth. Your answer to that as an individual is don't be on the wrong side of the divide. Invest in yourself, invest in acquiring marketable skills so that you can increase the utility that your labor provides others. You make money by providing a good or service that you can sell to somebody who values the good or service that you provided more than they value their money. If you are reliant on society to take care of you in the next 40 years in the way that they've taken care of you in the last 40 years, you're going to be very, very, very disappointed. You're going to have to invest enough in yourself that you can generate enough utility for others that you are on the right side of the wealth disparity. That is more possible than it's ever been. There are more technological tools than there have ever been. There is a broader, more diverse market than there has ever been. But this is not the circumstance where the wind is going to be in your sails the way it has been the last 40 years. You, as an example, can talk to, as a consequence of different social fabric and different technologies, you can, Christian, with your own podcast, reach 10 or 20 million 10 or 20 million people. The size of your audience is all about the content that you create and how it serves your audience. When I was coming up in business, that was unavailable to me. So the tools are here, but you have to develop the skills to use the tools, and you have to serve an audience. The audience is right in front of you. The audience is for free to grab, but you have to grab it. And that's something that your audience needs to take home with them.
Well, you mentioned media. I remember Naval Ravikant's book. I remember reading it. I think it was earlier or last year. He said, media and code are the highest forms of leverage. And that's all I needed to hear. If you could perhaps share, and I know you've mentioned on other shows like Adam Taggart's show, which is a great show, I have down a multi-decade commodity bull run, things of that nature, and perhaps ways in which you are hedging your own portfolio and others for this, crisis at hand.
Yeah, I mean, I think one obvious trend, and we've talked about it ad nauseum now, is the deterioration of the purchasing power of the U.S. dollar. Let's say you're an old guy, a Rick Rule. You're 72 years of age. You've done well, made a reasonable amount of money. You're getting Social Security now. and I don't know what they're paying me, 4,000 a month, 4,500, something like that. And that's part of your retirement plan. What I think I'm telling you is that they will continue to honor the nominal obligation. In other words, they'll continue to pay you $4,000 a month. The difficulty is that it'll only buy you $1,000 worth of goods and services. It's important to know that. And I think that the consequence of that is that you need to make plans to sustain more of your own retirement, more of your own lifestyle. You need to rely on society less. There are asset classes that have traditionally done well during periods of inflation. Intelligently leveraged real estate. By intelligently leveraged, I mean fixed mortgages, not floating mortgages, where you can increase the rents that you charge in line with inflation, but your cost of capital doesn't go up. Gold, capital intensive assets where would be competitors can't compete with you because they can't afford to build new productive capacity to compete with productive capacity that you have already built. You look at the whole range of asset classes that worked in the decade of the 1970s, and I suspect that they will work well in the next 10 years. You will recall, or perhaps you won't, perhaps you're too young, but I will remind you that in the period 1968 to 1982, we had a 14-year bull market in equities, and we had an 8-year bear market in bonds that was absolutely catastrophic. Despite that, some securities investors, Warren Buffett as an example, enjoyed 20 to 25% compound annual rates of return during a period of time when the market was flat. There's asset classes that you avoid in periods where there is financial uncertainty. The most important asset class to avoid is long bonds. If you own a 30-year treasury and the purchasing power of the distributions of that treasury are disappearing at 7.5% a year, while you're getting paid 4.5% a year, what happens is that if you buy that bond, you get poorer and poorer and poorer every year for 10 years. And so you need to use some common arithmetic sense around certain asset classes at the same time that you look for asset classes that perform well in the set of economic circumstances that you expect to occur.
Could you perhaps share some common misconceptions or perhaps other things that you feel don't receive enough attention?
Sure. George Soros once said that he made his fortune by finding broadly held public perceptions that were wrong and betting against them. And that served me well in my career. Not quite as well as it served him, sadly, but it served me well in my career. So, what are some public perceptions that are wrong? The most glaring to me as a natural resource investor is the twilight of fossil fuels. If you listen to the big thinkers of the world, that noted energy physicist Greta Thunberg, as an example, or our former president Joe Biden, or the former prime minister of Germany, Angela Merkel, they will tell you that peak oil demand occurs in 2030 or 2032, that we've reached the sunset of conventional energy. I would point out a couple things to them. The first is, as a species, we've now invested $5 trillion in alternative energies to replace hydrocarbons, and we've reduced the market share of hydrocarbons on a global basis from 83% 40 years ago all the way down to 82% today. A $5 trillion investment has reduced the market share of fossil fuels by 1%. Meanwhile, 1 billion people on Earth are going to experience the availability of power for the first time in their lifetime. And the rest of us, through things like data centers, are increasing rather than decreasing our power consumption. We need more of all forms of power. Wind? Sure. Solar? Why not? Geothermal? That too. Oil? Absolutely positively. Nuclear? Yep. That's it. The consequence of our belief that fossil fuels are disappearing means that coal cash flows are very low. The skeptics point out, well, the Chinese are building more solar capacity, you know, than anybody else in the world all the time. They're building more coal capacity too. Whether you like it or not, oil and gas and coal probably experience peak demand in 2065. And the decline in peak demand will be more about the evolution of conservation and also the conservation technologies. In other words, to say the more efficient utilization of hydrocarbons and the more efficient utilization of nuclear than anything else. What that means is that the oil stocks, on a net present value basis, the way that they've traditionally been valued, are probably selling at half normal market multiples. That doesn't mean that oil stocks are going to skyrocket in 6 months. Remember, I'm talking about changes that take place over the 2-year and 3-year and 5-year and 10-year timeframes. But the real obvious takeaway from that is the broadly held public perception that's way long is that fossil fuels are in their twilight years. They're not. They're still in ascendancy. A different one is that humankind, well, let me put it differently. Many people in my area of expertise don't understand that we have, as a society, been underinvesting in productive capacity around natural resources for at least 3 decades. The oil industry today is, including the parastatal oil companies, believed to be underinvesting in sustaining capital to the extent of about $1.5 billion or $2 billion a day. A day. And that means that their ability to produce 2 years out, 3 years out, 4 years out becomes increasingly compromised. Never mind new project expenditures. We've done the same thing in copper. We have looming supply deficits in copper, not next month, but 3 or 4 years out, that are absolutely positively inescapable. This is absolutely going to occur. Whether or not it has an immediate price impact is a different question. If we are, as some people suggest, heading into a synchronized global recession, you can have reduced supply if you have reduced demand and it doesn't impact price. But what it really does is it postpones as opposed to eliminates the reckoning. Does the reckoning occur in 3 years? Does it occur in 5 years? Does it occur in 7 years? I don't know. What I do know, Christian, is as an investor, if I ask myself a question where the answer begins with when, not if, I'm asking myself a very good question. And with regards to commodities like oil, like natural gas, like copper, like nickel, the answer to the question as about supply shortages is an answer that necessarily begins with when, not if. A high quality question from my point of view. I think a different broadly held public perception that's wrong is that the current amount of gross domestic product taken by government, while it may grow, can't continue to grow at the same pace, and that our ability to continue to manipulate interest rates down politically will end at some point in time. We talked earlier about the arithmetic of debt and deficits in the United States. Let's talk about the arithmetic of interest rates. Most Americans, because they've lived through 40 years of benign economic climate, believe the government. They believe the CPI number. I would describe the CPI, and I have, as the CP lie. If you believe in the CPI, the deterioration of your purchasing power is proceeding along at about 2.5% a year. Not bad. But use some common sense. Look back to the prices of the basket of goods and services that you consume in the period 2020 to 2025. Have gasoline prices gone up by 2.5%? How about rents or mortgages or healthcare or health insurance or groceries? No. They've increased in 5 years by almost 50%. I would suggest to you that the deterioration of the purchasing power of the US dollar is progressing right now at between 7.5% or 8%. So how does that tie into interest rates? Well, traditionally, investors have demanded a 1.5 to 2% real yield uh, against the depreciation in their purchasing power. The U.S. 10-year Treasury yields 4.5 in a currency that I suggest is depreciating at 7.5% a year. That means two things. It means that investors who buy the U.S. 10-year Treasury are seeing their purchasing power reduced by 3% a year every year for 10 years. You give the government your money, and 10 years later, they give you back 40% less purchasing power. Not a great deal. It means something else, though. If interest rates were to return to mean, if the deterioration in the purchasing power of the US dollar is at 7.5%, that would suggest that the US 10-year Treasury would have to be yielding 9%. Given that mortgages trade at a premium to the US Treasury, it would suggest that the mortgage rate has to go to 10 or 11%. If we don't control the debt and deficits and we don't control inflation, what happens is that we experience an interest rate cycle that's similar to the interest rate cycle that we experienced in the 1970s, where the prime rate of interest rose from, at the beginning of the period, 5% to, at the end of the period, 16.5%. People need to take that into account. To the extent that you utilize debt in your own capital stack, particularly with regards to your mortgage, get that mortgage fixed. Uh, if then the inflation falters, which is to say, if the government somehow gets its bad habits under control, you can refinance. But for sure, don't get yourself caught in a circumstance where the interest that you pay is market rate. Also, do not buy long-term fixed rate debt obligations. If you buy a U.S. 30-year Treasury to yield 4.75 and the interest rate goes to 15, what happens is that the capital value of your Treasury fell by 50 or 70%. You have a long-term asset that you get cut in half in. So it's very common, pardon me, it's very important that you use your common sense around how you organize your portfolio for the 10 years ahead of us.
You know, the word that comes to mind that I've become fond of here in Ontario is pernicious. It just seems like it's just rigged, like and just your average Joe, if you will, Westerner in the world, whether you're in Europe or here, is most people are just totally unaware. And again, I wasn't, well, not that but I was first introduced to what we're talking about, sound money and things of that nature, really about a year ago. So I mean, thankfully I'm learning it now than later on, but it seems spooky. If I might ask, I mean obviously those who hedge themselves appropriately are going to come out on top, whereas those who don't are in for a mess. But I guess at a macro level, who do you see coming out as on top? Like, do you see the U.S. still continuing? Do you see another, not to go off too geopolitically, but I've heard some mention China's supposed to come out on top, or or so on and so forth.
I'm uh, I've done business with the overseas Chinese community and later in China for a very long time, and I have a high regard for the intelligence and the discipline, for the Chinese predilection to education, and for their pragmatism. Um, I guess that sounds racist, but I guess I am a pro-Chinese racist. The difficulty is that they've evolved a system in China where 10,000 people have control over the lives of 1.4 billion people. There's a very bad feedback mechanism there, much as the increasing concentration of power in the United States in the hands of the US government is bad for the United States. But in China, it's really exaggerated. And so you have two conflicting forces. The urbanization of China, which is great, the predilection for savings that the Chinese people have, which is great, the Chinese tax code, which is absolutely fantastic. You know, Christian, if you and I went to build a tilt-up concrete factory in the U.S., we would be allowed to depreciate that for tax purposes over 33 years. A Chinese investor expenses it. It's an extremely investment centric rather than consumption centric tax code. That's all good. The bad news is that the state mobilizes the savings of their citizens to the extent that they can, and they invest them in politically expedient domestic spending programs rather than entrusting the Chinese, who are superb investors, a bit speculative, but superb investors, to do that themselves. And that's my fear. The Chinese banking system is intensely political and intensely opaque. And I don't think that the Chinese themselves know very much about what the portfolio at risk in terms of their domestic banking allocations are. And I think the possibility of a real train wreck is pretty high. I think they'll work it out. I do. I think there's an incredible pragmatism in China. And I have to say, among the people that I have met in the Chinese elite, uh, particularly in uh, companies like CITIC or Fosun or Zijin Mining, they're very high quality people. I just don't believe in a system where 10,000 people have the ability to run the lives of 1.4 billion people.
Yeah, it's very interesting what they've been able to effectuate. Where, to your point, the government is really able to be aggressive with things, and how much growth that China has experienced over the last handful of decades. I think the U.S. and the West more or less is kind of in decline. And I guess my other question to you, and as it relates to, I'm thinking of the time that we have together here. Some have said that the West has no choice but to get into scuffles or kinetic conflict with other countries, especially countries that seem to be kind of a threat to the U.S. What's your thought process on that? That when in
I
doubt,
think
they
the
go to
threat's
war,
the other
kind of.
way around. The U.S. government has U.S. troops deployed in 100 countries worldwide. I'm not an expert in things like this, but when I look at defense in the dictionary, it doesn't talk about forward deployment. Defense means the security of U.S. interests inside the U.S. border. Uh, we talk about the belligerence of Iran. Can you imagine these guys had the courage to cite their country around so many U.S. bases? The temerity of them to cite their country, uh, to live in the proximity to so many American bases. I would suggest that every country in the world uh, look at their greatest threat, which is conveniently located to the left of their right ear and to the right of their left ear. The biggest threat that we have as Americans is the threat posed to us by our debt, our deficits, and our belief that other people are the causes of our own problems. 20 years ago, we could have solved most of our foreign threats by giving their leaders passports to the United States. We have begun to debase that franchise, so our passport is less attractive. But we could solve our problems if we focused on solving our problems rather than blaming other people. What the Chinese are doing today, in terms of attempting to secure supply lines for natural resources around the world, is precisely what the United States of my youth did in the 1950s and the 1960s. Our foreign policy was mercantilistic. We went around the world. We gave foreign aid. We negotiated treaties that secured our access to things like foreign oil. What the Chinese are doing is they're having the temerity to copy the US playbook, which was also copied by the Japanese, which was also copied by the European Union. Um, I think you get where I'm going with this. The US defense budget has nothing to do with defense. It has partly to do with the military industrial complex. It has partly to do with the xenophobic sense that we are, in effect, the Politburo, that the US Senate should control the aspirations and the independence of 8.2 billion people worldwide, most of whom don't have any call on US elections. We need to solve our own problems.
Couple other questions real quick here. Obviously in a sense, you're kind of an international man. You do, I imagine extensive traveling. You have an
Yep.
extensive Rolodex, I'm sure, Rick. Is there anything that you have observed, perhaps in conversations that you've had with people in private and such, that whether it's alarming or just anything, just kind of interesting, noteworthy about kind of what kind of goes on behind the scenes?
Uh, let me tell you this. What separates us from other people is very visible. It might be that they're black, we're white, all these things. It might be they're young, we're old. Uh, what I've learned, 72 years on Earth, 50 of them doing business, is that people are pretty much the same. We want to laugh. We want to be able to feed our families. We want self-respect. We want to be treated well by other people. The differences that we have, if there was a 360-degree sphere that was human personality, our differences are maybe 3%. Our similarities are much more like 357%. And I suspect if we spoke a little softer and smiled a little more, if we focused on how we delivered value as opposed to how we extracted value, if we focused on win-win transactions as opposed to win-lose transactions, that most of the problems that we face as a people, and damn near all the problems that we face as individuals, would go away. I think I said at the beginning of the program, if you the rich-poor divide is going to grow. Like Ayn Rand said about the poor, the best thing that you can do for them is don't become one. Don't compete with them for resources generated by others. Learn how to generate resources yourself by serving markets better. Figure out what it is that you like to do and figure out a way that you can deliver a good or service that is of more value to your customer than his or her money. And you're going to do fine. And the conjunction of you doing fine and me doing fine and a bunch of other people doing fine is that humanity does fine too. If there are more producers and less detractors, we're going to do well. I think it was Al Gore, hardly, not Al Gore, I'm sorry, Gore Vidal, got the wrong Gore. Gore Vidal, hardly a libertarian, who once said, as an observation, that politics could be defined by looking at the root of the word. Poly, of course, from the Greek for many. The tick from the English colloquial for small blood-sucking insect. So if you looked at politics as a coalition of small blood-sucking insects, each trying to suck the lifeblood out of others, you understand what it is for you or what it is for society to rely on politics to solve distribution problems. It's something that you need to solve for yourself. And if you solve it for yourself, and if you encourage and assist other people in solving that same problem for themselves, you've really solved all the problems facing humankind.
Amen to that. Rick, I appreciate the time that you allocated today. How can people get in touch with you, learn more about you, and of course, your Rural Symposium that you have next month?
I'll make it worth their while. If you are or want to be a natural resource investor, go to my website, ruleinvestmentmedia.com. List your natural resource stocks, and for free, I'll evaluate them. I'll send you back the rankings by email, one being best, 10 being worst. I'll comment on individual issues if I think my comments might have value. If you want to learn more than that, if you want to learn how to do your own securities analysis, go to the Rule Classroom. Join 14,000 other natural resource investors in a free service. A couple hundred hours of instructional programming at the Rule Classroom and the ability to exchange notes and interact with 14,000 other students. Again, absolutely free. The pinnacle product, of course, is the Natural Resources Investment Symposium, July 7 through 11 in Boca Raton, Florida. That's not free. I charge for it, but it comes with a no questions asked money guarantee, a riskless transaction, one of the few remaining riskless transactions on planet Earth.
Love it. Well, Rick, again, thank you so much. Hope to have you on later this year.
I look forward to it. Thank you for this opportunity.
Quick ask: over half of you who watch the show regularly haven't yet subscribed. If you've enjoyed the show, you're finding value in it, subscribing is really the best way to support the channel. It's of course, free. It literally takes 2 seconds, and it lets the algorithm know that this content matters. And of course, my commitment to you is going to be that I'm going to continue to bring on great guests, refine those questions. And of course, I'm always receptive to your feedback. If there's certain people that you'd like to have on, or certain questions, or this, that, and the other that you'd like to have as part of the show going forward, things of that nature, please let me know. I'm pretty easy to access. Anyhow, that's my commitment to you. If you can subscribe, that would mean a lot. Thanks.